What is top-down analysis? Top-down analysis is a technique that combines the analysis of multiple time frames and market factors to gain a comprehensive understanding of market conditions. Starting from higher time frames and zooming into lower details allows us to get a major view of market direction in key areas at all levels. But remember, starting from the monthly time frame, applying every single concept out there will make your chart look like this when you reach your entry time frame, which is completely useless. This video will teach you what to exactly look for in each of the time frames to make a well-educated analysis of any chart easily. But first, why do we even need to combine multiple time frames? Well, here are the top 3 reasons. Number 1. Overcoming directional confusion. Here on the pound-dollar 5 minutes chart, the market looks choppy without any visible direction. It continuously violates the structure levels to both up and down sides, confusing any trader trying to identify the direction. But if we zoom out to the 1 hour's time frame, you can quickly identify the market trend and the bearish pressure. This area is the same area on the 5 minutes chart we were previously observing. So, by knowing the higher time frame directional bias, we can take short entries with confidence in the 5 minutes chart. Remember that whenever you are confused about the direction and the market keeps violating key levels of structure, you are focusing on the wrong time frame. So analyzing the bigger picture helps you to enhance your ability to take more precise and confident entries. Number 2. Increasing accuracy. A minor reaction to a higher time frame key level can be a significant trend change in the lower time frames. So before placing any trade, we should check how much room we have before tapping into a higher time frame supply or demand area. This will help us understand how to set our targets, stop losses, and avoid losing trades. Here on the Euro-Dollar 15-minute chart, we had a strong bullish move with a clear fair value gap between the shadows. As a result, we have a valid order block, which is an excellent opportunity to go long. However, the market suddenly changes direction and ignores the demand order block, and in case you are wondering, here is why. If we zoom out to the 1 hour time frame, we can see that this change in direction could be due to reaching a higher time frame key level that acted as strong resistance multiple times previously. So checking the higher time frame key levels could help us avoid this kind of unnecessary risks. On the contrary, look at another example. Here in the 1 hour's time frame, we have a move with obvious inefficiency breaking above the previous market structure. So here, if the price manages to pull back to the order block zone, it would be a perfect opportunity to enter a long position, set our stop below the swing low, and target the next level of market structure in front of the price. So let's see what do we have on the higher time frame. Here on the 4 hours, we can see that we have recently broken above these supply areas, so demand is in control, and we have enough room to go before reaching the next unmitigated supply area in front of the price. So could be a perfect trade since we have combined higher time frame levels and directional bias with a lower time frame entry setup. Number 3. Optimizing trade entries. Analyzing multiple time frames allows traders to identify optimal trade entry and exit points. For instance, imagine if you were waiting for the price to pull back to the order flow area and open buys to go along with the bullish momentum. If we set buy orders at the beginning of the zone, our stop will be too large. So an optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps to get in the trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis.